morning, everybody, and welcome to the presentation. Thank you for joining us. I'd like to start today's presentation with a very important concept, which is the idea that a portfolio is like a sports team, whereby basically you're the coach as an investor, as a CIO, and where internal and external managers and strategies, we are the players. This is not just about the individual merits, it's about how we play together. And this is a game where we're looking at investment success being the balance between capital preservation, which would be effectively defense, with compounding that capital in the form of income and capital gains, which would be the conventional offense. In that sense, Quadriga, Igneo, UCITS, which you can see here in blue, and the S&P in white, we could consider the S&P being a conventional striker strategy that does well during more benign markets, and where Igneo could be the defender or the goalkeeper, as you can see from obviously from just visually from the negative correlation. With that, perhaps to introduce myself, I'm for those who don't know me, I'm Diego Parrilla. I'm a mining and petroleum engineer, originally from Spain. I did my master's in mineral economics from the Colorado School of Mines and the French Institute of Petroleum in Paris. And I started my career some 23 years ago with JP Morgan in London on the macro commodities trading. And I was with Goldman Sachs and Merrill Lynch, where I was eventually global head and management committee. The second half of my career was on the buy side, initially on my own and also with a couple of large players such as Bluecrest and Diamond, before I moved back to Spain about 3 years ago to join Quadriga Asset Managers, an independent 1.8 billion asset and wealth manager, where together with my colleague friend Alfonso Torres, I manage Quadriga Igneo. In addition to my experience on the buy and sell side, I'm also a best-selling author. My first book, The Energy World is Flat, was published in English, in Spanish, and Chinese. It was a very contrarian thesis at the time, 2014, $120 oil, and challenging the status quo and consensus of peak oil. So my thesis of the flattening of the energy world, 30 to 50 oil, sounded perhaps like science fiction at the time, but it's been reinforced with the passage of time. And I kept that discipline of writing, and I published a second book called The Anti-Bubbles, and I've done some selective contributions, such as this article published on the front page of the FT, where I effectively put forward a contrarian thesis. And I'd like to share with you the concept of anti-bubble, which is central to the thesis and also to the strategy. And I'd like to start by borrowing George Soros' definition of bubbles, which he defines as assets that are artificially expensive based on a belief that happens to be false. It happens to be a misconception. It's a situation where the emperor had no clothes. So in that sense, the concept of anti-bubble, what I did is I generalized Soros' framework, and I introduced the concept as, first of all, assets that are grossly artificially cheap. So in that sense, we're talking about bubbles and anti-bubbles being, in a second dimension, almost mirror images of the same misconception. So by construction, we're looking at assets that, in terms of catalyst and timing, will implode and explode at virtually the same time, because they're effectively the same process. And there's an important third dimension, which is this idea that they are interrelated. They sort of feed on each other, and that provides with some element of risk premium. So anti-bubbles being both extreme value and effective hedge and risk premium, we could look, for example, at a clear bubble anti-bubble relationship, such as the S&P and the VIX. And what I would argue is that during periods of extreme complacency, when implied volatility is artificially low, that is supportive of effectively artificially high valuations. And this is both for qualitative and quantitative reasons, both complacency as well as systematic selling of volatility and other forms. This can unwind in a situation where effectively you see volatility exploding and the synchronous collapse of the valuations in a situation of panic. And what's ironic about this is that effectively the market is giving us the cheapest insurance when we need it the most. So arguably nobody wanted to buy puts in the S&P at 3,400 when the VIX was at 11, and everybody's panicking to buy, when it's 2,480 vol. So in that sense, Igneo is a strategy that applies the framework of the anti-bubbles as a goalkeeper, and as an individual player is a strategy that has enjoyed very high absolute returns. We're talking about close to 60% since launch, over 33% per annum. So in terms of the actual absolute returns is very strong. If we look at risk-adjusted returns and we look at the average volatility, conventionally people look at SHARPE or information ratios, where you look at the return per unit of risk expressed as average volatility. And in that sense, the strategy also scores very highly with a SHARPE of 1.5. But it's very important to understand that the SHARPE ratio or average volatility works when you're looking at symmetrical distributions. But if you're looking at asymmetric distributions, it could be actually hiding a lot of risk. So you could have a strategy that might be selling tail risk. It collects a lot of premium. It looks like a really nice return per unit of volatility, and then you explode or implode. And this is something that unfortunately people have suffered. So I would call and ask people to beware about the SHARPE on its own. And that's why we argue that SORTINO, it's a better way of looking at things. That measure of asymmetry is something that is a big strength of Igneo, which is highly asymmetric on the right tail. What it means in practice is that when you think about volatility, it's not just about average volatility. You need to differentiate between good volatility. Nobody called me to complain when we made 16.5% in August or 19.1 now in March. Clearly, the concern is really about the bad volatility. And in that sense, the strategy has realized just 6.7% of downward volatility, which comes out to an extraordinary risk-adjusted return of over 5 in the SORTINO. This, in football equivalent terms, we score 5 goals per opportunity created by the other team. So it's really just outstanding. Going back to the Igneo and the S&P, we see that we have performed strongly each and every single time as a goalkeeper that the S&P and risk markets in general were under pressure. Obviously, the S&P, if we did this analysis relative to the IBEX or emerging markets or high yield, the numbers would be even more compelling. And we see this consistent performance, obviously looking at March, very, very extreme. But also on the other hand, it's remarkable that during the more benign and bullish markets, the strategy is achieving its objective of protecting the capital and even making money, as it was the case in April, where we had the biggest, largest gain in the S&P since 1987, and the strategy was also up. So when we look at the monthly returns and we sort them in order from the orange bars, from the worst performing S&P to the best performing, what we see is very clearly the strong correlation, negative correlation of -1, where we've realized very strong returns, even greater than the losses incurred by the S&P during these periods. And on the other hand, how we've managed to contain effectively and manage protect the capital. This is not something that happens by luck, or it's something that happens by design and by construction. So the strategy is run with 3 key objectives. The first one and most important is capital preservation. So avoid large drawdowns at all costs at any time, regardless of the market conditions. Then we want to generate these large absolute returns during adverse and hostile markets, and which looks like a synthetic put on risk. And if you think about this, normally put would come with some significant, potentially negative carry, where we are achieving is to have neutral or even positive carry and expectancy during more benign markets. How do we do this? The strategy is composed of 3 key building blocks. The first one, which accounts for roughly 50% of the NAV, is invested in gold, in precious metals, which is one of the key anti-bubbles in the system. And but we run it in a dynamic basis, where we have the ability, whilst keeping gold as the main component, a minimum of 35%, we have the ability also to rotate into silver, platinum, palladium, or gold miners. But we do this, very importantly, with no leverage and no shorts. There's a second component, which is core allocation to US Treasuries. This represents roughly 20 to 30% of the NAV. And here, just like the first building block, we also have the ability to rotate, in this case, across duration. And these 2 building blocks, we add 1 extra layer of capital preservation, which is what we call the capital preservation insurance. But it's very important to understand, and this is critical to survive and thrive during hostile markets, that there's no leverage and no shorts. Lots of strategies, as we'll see shortly, actually blow up and suffer due to these reasons. Now, capital preservation insurance is really this idea that, you know, I like to use the analogy of we're climbing a mountain or a wall. So when you're up 10, 15, 20 meters, no matter how good of a climber you are, you're going to be pinning yourself to the wall. It's not a race to the top. It's not even about getting to the top. It's making it back to the bottom. And you might have, you know, Trump or Xi throwing you rocks, or a crazy CTA, you know, going up without protection and then collapsing and taking you off. So by pinning yourself to the wall, by buying this insurance, means that when the market suffers big drawdowns, we're able to monetize this insurance and basically accumulate more of the assets that we like. So in that sense, when the market recovers, we see the compounding of this capital preservation, which eventually leads to superior long-term returns. So these first 2 building blocks, to summarize, is roughly 70 to 80% of the portfolio. It's effectively the long plus the put gives us some kind of rolling synthetic call on assets that we're running with no leverage and no shorts. So it's a very conservative. But what really makes the strategy unique and stand out is the third building block. This is in a way where perhaps the meeting becomes more interesting, is the fact that we have long-only insurance. The idea here is we have, as goalkeeper, we have the ability to buy options. Most important thing for you to remember is that we can only buy options. We can not short options. We could obviously take profits, but we can't go short. And what it means is that with 100% certainty, we cannot lose more than the premium. This is hugely important because there's lots of people. I mean, when I was on the commodity side, I've seen people with $1 million of VAR lose 50. You know, you could have a long short that feels very safe, or WTI versus Brent, or Ford versus Tesla, or whatever, completely blow up. So here, you know, we sleep at night. We have this long only insurance. The question is, as a goalkeeper, what can we do? What should we do with this? And there are really 2 main uses for this option program. The first one is, at the end of the day, I'm looking to make money during hostile markets, so I can buy put options on risk assets, be it equities, credit, high yield, EM, commodities, or whatever. But I also have another choice, which is I could effectively be buying call options on more defensive assets, be it gold or US Treasuries or the dollar, or of course the VIX. And this effectively gives us a very diversified program with lots of options on a long-only basis, which creates overall a very predictable strategy that does what it says in the tin. Now, I insist on the option and the fact that we can only buy them. Now, let's look at the objectives here, which are quite demanding. And the idea here is we have, first and foremost, because we think in premium, we have a budget, I can't just spend infinite amounts. We are looking to spend and currently have about 25% of the NAV, but roughly this is 5 to 7% per annum. So we want to do this in a diversified way, which means we're going to look for the cheapest option possible in terms of premium. On average, we spend about less than 1% per position, which gives us 20 to 30 uncorrelated diversified options. The second objective that we look for is we want these options to be very explosive. We're looking for 5 to 1, 10 to 1, 20 to 1 payouts, which effectively means that when you're long these puts and these calls, the strategy will behave and perform strongly as it's done during every crisis. And third, and this is, some people scratch their heads, we try to do this with neutral or even positive carry. The Black and Scholes gang, people who think about options as, premium being the trade-off between theta and gamma, implied versus realized, running a delta hedge strategy, path dependent. This is one way of thinking about options, and they struggle with the idea that you can have a long option with positive carry. But if you think about it more as a Monte Carlo, effectively the premium represents the expected payout of X paths based on implied volatilities and correlations and skews, is perfectly possible to define, and that's what we do very successfully, if I may say so. So in that sense, we are, very conservative in the approach by buying these options, but we do it in a smarter way. If we take a snapshot of the portfolio at the end of February, you get a sense, and by the way, we were the best hedge fund in the world in February with plus 10% from what I gather. But effectively what you see is that after the end of February, we were sitting on about 23.8% of premium at risk. That represented with an 100% certainty the worst case scenario. It's the upfront premium plus the mark to market of those options. This is, as you can see, a combination of calls on gold and treasuries and dollar, as well as puts on the S&P and risk assets, but it's also very diversified through time. So we see that of that, about 7.8% was at risk in 2020. And if you zoom in, you see that it's not just about vanilla options. We actually take advantage of correlation and other things. So instead of betting on something that gold, on a 3 to 1 bet on gold higher, we may combine gold higher and S&P lower to get a 10 to 1 payout. So what you see there is a number of pairs as we look through 2020, 2021, 2022 and beyond, and we have some options that go all the way 30 years. Effectively, you are going from a world where you start with more gamma, and punchy directional moves to something in the more longer dates, which combines more interest rate moves and Vega. So let's see what happened in March. And basically what you see is that Igneo stood out and outperformed everybody, including all the conventional goalkeepers and defenders, such as obviously gold or even US treasuries or long-dated bonds. In fact, it's remarkable that during a period of March, as risk parity was being destroyed, you had some of these safe havens being collapsing whilst Igneo did well. So in that sense, what you see and what happened during the month of March, as an example, is during these hostile markets, there's a few things that happen. First, some parts of the portfolio had some mark-to-market gains. Some parts of the portfolio had some mark-to-market losses, such as gold. And we saw some of the options literally exploding. This, VIX calls or S&P puts contingent on the dollar, effectively exploding. We take profits very actively in this, and it's very important to understand that when we take profits, these profits become capital. So they get reinvested back into gold, into treasuries, and into insurance. And this is something we do in a forward-looking basis. So the fact that $3 million in VIX calls made us 22 million doesn't mean I need to reinvest that in VIX calls. We look forward and we see the opportunity perhaps being more in calls on gold or puts on the yuan or combinations. In that sense, we are actively restructuring and rebalancing the portfolio constantly. What it means is that, you know, at the end of March, you have effectively a portfolio that is back to a more kind of neutral profile, which obviously you have significant gains, you know, call it 40 to 50% in the year, but effectively something that it has very important considerations the way we manage this. The first one is that because the strategy, doesn't matter if you invested 2 years ago or 6 months ago or last week, the strategy at all times has a very smooth and predictable behavior. It's, in that sense, the best compliment we got from our existing investors is that the strategy does what it says in the tin. It's, as I said, it's very smooth risk profile. So some people might have been concerned, Diego, you guys are up so much in the year. What happens if I enter now? And I said, well, right now we see equal or even better opportunities than we did before because we're forward looking, we've taken profits, and this is now capital. So in that sense, we are, it's a very repeatable process. We're constantly focused on finding the right risk reward and taking profits and focused on a symmetry of outcome, not of conviction necessarily. And we do this in a way that is with daily liquidity, which means investors can rebalance. If we look forward, you know, into the end of April and where we're now, you will see that the premium at risk is also around 25%. But if you notice, there's a number of positions that have been disappeared. We took profits or expired, and positions that are new and position us on this forward-looking basis. Many of these positions are structural, are effectively core defenders, such as things like gold or treasuries or volatility and correlation, or various position on equities or credit, but also things that are slightly more tactical, such as, you know, very situation on China, or structurally, you know, dollar versus DM. Now, with this, I'd like to move on to the second section, which we'll discuss briefly, how much to invest in Igneo. And this is beyond the merits of Igneo as an individual player. It's also a fantastic team player. So what you see is, you know, very often, I think many investors' portfolios have been suffering from the risk of false diversification. So you have a bunch of assets in your portfolio, you think you're diversified, and the reality is that when things go wrong, everything falls at the same time. This is a mindset, what I would call a striker mindset. Everybody's thinking about making money, income and capital gains, ignoring the other part of the game, which is defense. And somehow with complacency that mommy and daddy, the central banks are there, it's almost like the referee is on their side. A few problems is, you know, one is things like the Bund, you know, or the treasury to some extent, where I call it the Bund Franz Beckenbauer. You know, it was a great defender back in the day. He's now 73, 74 years old. So with negative yields, unfortunately, the defenders are no longer. And in that sense, the conventional 60-40 balanced portfolios are highly imbalanced. Cash, which some people think it's a defender, to be honest, is more like a striker in the bench, waiting for more strikers. And to some extent, trend followers or other strategies that have been sold or missold, in my view, as defenders happen to lose a lot of money during this hostile market. So I think this gives a lot of emphasis in Igneo and the anti-bubbles in general. It also has an important consideration, which is timing, you know, and how some people, some coaches think, I can play with 11 strikers and then move all the way to defenders. Is not as easy as it sounds. So I think it's more about finding that balance all the time. So let's look into that. And as we look at Igneo on a standalone, we look at the S&P and how it does. The question is, if we look at a team that was a 50-50 passive basket, what we see is two things very clearly. The first one is the return of the 50-50 passive basket is obviously the average of the returns. So we would have achieved something around 19%. But the interesting thing is that we achieved this with a fraction of the risk. As you can see, the drawdown and volatility and the maximum drawdown peak to trough was only 3.3% throughout the entire period, which shows you this strong negative correlation. In fact, the drawdown is so low that obviously leads to very high risk-adjusted returns, but the drawdown is so low that we could apply what I call smart leverage. Smart leverage, as opposed to dumb leverage, which is, oh, high yield pays me 1%, I want 5%, let's just lever ourselves 5 times, and before you know it, you're dead. The smart leverage is effectively leveraging assets that are negatively correlated. And here, by entering into an 80-80 basket, what we see is that the risk increases marginally from a drawdown of minus 3.3 to minus 5, but we are increasing the return by about 1.6. This is so remarkable that when you actually compare it back to Igneo or the S&P, you see that the basket is superior, has achieved higher returns even than Igneo, with a fraction of the risk, which comes out with just, out of the charts, Sortinos in the region of 8.6. So this is something very important, and part of the reason why many of you, the CIOs of pension funds, insurance companies in Germany, in Switzerland, in the United States, in Spain, in the UK, in everywhere, in Asia, have been supporting us. So thank you very much. We're already around 350 million with a strong pipeline. As part of this process, we've had consultants doing on-site due diligence, which we passed successfully with top grades, such as Axia or Castle Hall or others. And effectively, the strategy is available, as I said, through a number of vehicles. We have the biggest one today is UCITS fund, which is called Igneo. We also have some live customized managed mandates through SMAs. We're going live in the DB Select platform with a sister strategy called Smart Gold, which is identical to Igneo, but non-UCITS. And as a result, we have a target of 100% in gold. And we are working on a US onshore fund. We do this with top partners. We're already in the main platforms such as Pershing, Allfunds, and with top tier, in addition, obviously, to Morgan Stanley. And we do it with a very, very aggressive fee structure, which is effectively we have two extremes. One is the management fee only. The clean share class is 1.5 and 0. This is something that we've done with the view that, some large pools of money, whether it's a passive ETF or money markets or gold or whatever, or treasuries go. But we have also a second share class that shows you the skin in the game and the alignment of interest, which is 0 and 20. I don't think there's a lot of people out there with this kind of alpha that are willing to do things at 0 and 20, and even less defenders or goalkeepers. These strategies are available in dollar, in euro, and sterling. They are settled, not hedged. Let's have, before we jump into the Q&A briefly, and thank you for the questions you're submitting. Let's look briefly at the outlook. This is a brief overview, and I would argue that the three main tectonic plates in what's happening now. We're in the middle of a big paradigm shift. The first one is, I would argue that the damage is already been done, and to some extent. The last decade, we saw the transformation of risk-free interest into interest-free risk, effectively creating this series of parallel synchronous bubbles and anti-bubbles. And then we've had a second issue, which is the obvious COVID-19, which is a shock without precedents in terms of volatility, supply shock, demand shock, health shock, political shock. And then we've seen a monetary and fiscal response without limits and without precedents. So in terms of speed and size and scope. Now, to briefly summarize the view and why we think it's prudent and we see great opportunities. We think the next decade will be the transformation of bubbles that are too big to fail into inflation. There's going to be very intense dynamics, but we think a global recession is extremely likely, almost unavoidable. We think that liquidity and debt may not solve insolvency, so we will see credit events, yes or yes. We will see this short-term deflation as an excuse, in my view, to print even more and create an inflationary problem on the medium longer term. We also see and believe that artificial valuations will not last forever. So we saw an interesting move last night, more of that to come. We think that the virus will go, and hopefully we'll find all the measures and vaccines soon, but we think that MMT will stay. It's very, very difficult to unwind many of these measures once they're in place. We think volatility is likely to remain elevated, probably with a 30 sort of handle for the foreseeable future. We think higher interest rates would definitely burst all the bubbles, so we think that rates will remain lower for longer, and currency wars will remain a big issue, where we think the clear winners are gold and also the US dollar, despite their efforts not to. With that, currency wars, the mirror image are trade wars. We expect China to be a major loser, and we think the Chinese yuan is a phenomenal opportunity it's a great entry point to basically buy insurance, put options against potential devaluation. We think it's a matter of when, not if, that it will happen, and it could be a truly major risk that the market is disregarding and offering extraordinarily cheap. With that, before we move into Q&A to conclude, I think with this view, we recommend balanced teams at all times. We think that at the end of the day, equities are more likely to capture, to be a better striker in an inflationary environment than credit. We think that real assets that are income paying and benefit from inflation could be a good midfielder, but we think that it makes a lot of sense, and playing this match without goalkeepers is just very risky. So we recommend to have these balanced portfolios, and as I said, we favor equities versus credit, real assets versus cash, and obviously anti-bubbles versus government bonds, which are all suffering from inflation and have limited upside. With that, I'm gonna open it to Q&A. I can see a number of questions have come in. I am not gonna have time to answer them all, but I endeavored to reply on email. So if you have further questions, please do. I'm gonna take one which asks, if I could give some examples about exotic options. And I'd like to say that, listen, if the market is giving us the opportunity to buy cheap vanilla options, then there's nothing better than a vanilla option. If you can buy health insurance that will cover you in the entire world, then great. But what you find very often is that this vanilla, could be cheap and could be refined to your needs. So, for example, in the case of health insurance, if you don't live in the US, you don't need coverage in the US. And in my case, when I did that and I removed coverage from the US, the insurance for the family halved. So about half of the cost of the health insurance comes from the fact that you could be in the US. Of course, you can hedge that with your credit card or in other ways if you have insurance there. But ultimately, if you look at things that combine, when you buy a vanilla call option on gold, it covers you against gold going up in every single scenario you can think of. If you buy put option on the S&P, it happens, and it gives you insurance against every scenario you can think of. It could be China blowing up, it could be Europe blowing up, it could be anything. Likewise for the dollar. The beauty is that when you combine these views and you ask the market, for example, what's your view on gold? And a 3-year vanilla call costs 15%. Well, as bullish as I'm gold, and I'm on the record saying it might be 3,000 to 5,000 in the next 3 to 5 years. As bullish as I am, 15% premium is a lot of money, so it would eat pretty much my entire budget. Second, it can suffer from significant negative carry. And third, even if gold is up 50%, you're barely making 3 to 1. But when you ask the market, what's your view on gold and what's your view on the dollar? The market basically tends to tell you, listen, very simple. If gold is up, then the dollar is down. And I say, well, how about buying an insurance against gold up and dollar up? And long story short, we're able to buy this at 80, 90% discount to the vanilla. Similar thing when you combine gold and the S&P, or similar thing when you combine the S&P and the dollar. So to give you an example, in March, we had an option where we spent 60 basis points buying at the money puts on the S&P contingent on dollar higher. The market thought it was literally impossible that, you know, if the S&P collapsed, dollar yen might be stable or higher, and effectively we turned that into 7.5%. So we're talking about $1.2 million becoming $15 million. This kind of extreme asymmetry, this is an edge that we have, and where we combine all these pieces. And with that, I think I'm reaching my time. Don't want to eat into the next presentation. So thank you all for submitting the questions. I will be I'll be responding to them, and I want to thank you all for your time, and I hope you find the presentation interesting. Thank you very much, and stay safe.